Have you ever felt like the financial world is operating on a different set of rules? That the economic principles you learned or the investment strategies you once trusted no longer quite fit? For decades, debt was a predictable force, a tool for progress. But today, it behaves in ways that challenge our fundamental understanding, shaping everything from household budgets to global markets. This isn't a doomsday prophecy. It's an invitation to analytically dissect the profound transformation of debt, credit, and liquidity and understand why the financial landscape demands a new perspective from economists, investors, students, and policymakers alike. The modern financial system is a complex tapestry, and debt is its most pervasive thread. While its fundamental definition remains unchanged, its operational dynamics have undergone a silent revolution. This series aims to illuminate these shifts, providing an educational framework for understanding the intricate interplay of forces that govern our economic lives. We will explore how historical precedents diverge from current realities, offering a thought-provoking analysis for anyone navigating today's financial currents. At its most fundamental, debt is an intertemporal contract. It represents the present consumption of future income, a mechanism allowing economic agents to bridge temporal gaps in their financial flows. From an economic perspective, debt facilitates capital formation, enables investment beyond immediate savings, and smooths consumption patterns over time. It is a powerful engine for economic expansion when deployed productively. However, debt's utility is intrinsically linked to the economic environment. When future income streams are robust and predictable, the burden of repayment feels light, encouraging further borrowing and investment. Conversely, in periods of heightened uncertainty, the same debt can become an oppressive weight, stifling economic activity and exacerbating financial fragility. Debt, therefore, is not inherently good or bad. Its impact is a function of the prevailing economic conditions and the prudence of its application. For much of the 20th century, particularly in the post-World War II era, debt operated within a relatively stable and predictable economic framework. Financial markets were often more regulated, and monetary policy, while evolving, generally aimed for stability and growth. This environment fostered a clear understanding of debt's role and risks. Interest rates, though subject to cycles, moved with a certain inertia, allowing for long-term financial planning. Inflation, while present, was often contained or understood within a cyclical pattern, providing a degree of certainty for both borrowers and lenders. Economic growth was often robust and relatively predictable, driven by industrial expansion and technological advancements. This predictability made debt a reliable instrument for capital allocation. In this context, debt served as a vital conduit for intergenerational wealth transfer and economic development. Governments borrowed to fund massive infrastructure projects, laying the groundwork for future prosperity. Businesses leveraged capital to expand production, innovate, and create jobs, confident in future demand. Households used mortgages to acquire assets, building equity and contributing to stable communities. Debt was a bridge, connecting present resources to future opportunities, supporting a virtuous cycle of investment and progress. The early 1980s marked a pivotal turning point, initiating a multi-decade trend of declining interest rates that fundamentally reshaped the global financial landscape. This shift, often attributed to disinflationary pressures, globalization, and evolving monetary policy frameworks, made borrowing progressively cheaper. The cost of capital, a critical input for all economic activity, steadily decreased, incentivizing greater leverage across all sectors. This prolonged period of falling rates had profound implications for financial planning and investment strategy. Lower debt service costs freed up cash flow for households and corporations, encouraging increased consumption and investment. Refinancing became a common practice, allowing borrowers to continually reduce their monthly payments or extract equity, further fueling asset markets. Balance sheets across the economy expanded dramatically as the perceived cost of carrying debt diminished. Consequently, debt transitioned from being a temporary financing tool to a structural component of economic activity. It became deeply embedded in business models, household budgets, and government fiscal policies. The expectation of perpetually low rates encouraged long-term planning built around sustained leverage, altering risk perceptions and investment horizons. This era fostered a reliance on debt that would prove challenging to unwind when conditions eventually changed. The distinction between debt supporting growth and debt sustaining the system is crucial for economic analysis. Initially, debt acts as a catalyst, enabling productive investments that generate future returns exceeding the cost of borrowing. This is healthy leverage, contributing to genuine economic expansion and improved living standards. It allows for flexibility, as debt levels can be adjusted during economic downturns without jeopardizing the entire structure. However, as debt levels accumulate and interest rates remain low for extended periods, economies can become increasingly reliant on continued borrowing to maintain current consumption and investment levels. When debt reaches a critical mass, it ceases to be merely a tool for growth and transforms into a necessary condition for systemic stability. At this point, the economy becomes acutely sensitive to any increase in borrowing costs or reduction in credit availability. This heightened sensitivity means that even small changes in interest rates can trigger significant economic repercussions. The unwinding of debt becomes incredibly difficult, as any attempt to deleverage risks triggering a recession or financial crisis. Policymakers face a dilemma: continue to facilitate debt accumulation or risk destabilizing an economy that has become addicted to cheap credit. This structural dependence on debt fundamentally alters the risk profile of the entire financial system, posing significant challenges for investors and policymakers alike. Household debt, while always a significant component of the economy, has evolved in character, presenting new vulnerabilities. The sheer volume has grown, but more importantly, the terms and conditions have shifted, reflecting the era of low interest rates. Mortgages, for instance, have seen extended terms, with 30-year and even 40-year loans becoming common, stretching repayment obligations further into the future. Housing prices, fueled by cheap credit and limited supply, have soared in many regions, requiring larger principal amounts and increasing the overall debt burden for new homeowners. Furthermore, the assumption of continuous refinancing, allowing homeowners to tap into equity or lower rates, became deeply ingrained in financial planning. This created a perception of flexibility that might not hold in a rising rate environment. While many households may not be overextended by traditional metrics, they are undeniably more exposed to interest rate fluctuations. A small percentage increase in mortgage rates, or a rise in credit card interest, can translate into a substantial increase in monthly payments. This reduces discretionary income, impacts consumption, and can quickly strain household budgets, making the economy more susceptible to external shocks. For financial planners, understanding this heightened exposure is critical for advising clients on robust personal finance strategies. The era of low borrowing costs also profoundly influenced corporate and government financial behavior. Corporations, finding capital readily available and inexpensive, significantly increased their leverage. This debt financed not only productive expansion and innovation, but also activities like stock buybacks and mergers and acquisitions, which can boost shareholder value without necessarily increasing productive capacity. The pursuit of higher returns in a low-yield environment led many firms to take on more risk, often through increased debt. Governments, too, adapted to the new reality. Low interest rates dramatically reduced the cost of servicing national debts, making it politically easier to run larger deficits. Borrowing became a primary tool for counter-cyclical fiscal policy during crises, providing stability but also accumulating substantial public debt. The perceived affordability of debt encouraged governments to expand social programs and infrastructure projects, often without fully accounting for the long-term implications of rising debt-to-GDP ratios. However, as these debt levels have risen across both corporate and public sectors, the entire system has become less flexible and more fragile. What once felt like a manageable cost of doing business or governing now represents a significant structural vulnerability. The ability of central banks to raise rates or governments to implement austerity measures is constrained by the potential for widespread defaults or economic contraction. This sensitivity to change creates a delicate balancing act for policymakers and introduces new layers of risk for investors assessing corporate solvency and sovereign creditworthiness. Today, debt operates within an economic environment fundamentally different from the past. We are witnessing a confluence of factors that amplify the impact of debt and challenge established financial models. The era of predictable, low interest rates has given way to increased volatility, driven by inflation concerns, geopolitical shifts, and evolving central bank mandates. This means the cost of money is no longer a stable variable, introducing significant uncertainty for borrowers and lenders alike. Furthermore, many developed economies are grappling with slower underlying growth rates, influenced by demographic shifts, productivity plateaus, and structural impediments. Slower growth makes it harder to grow out of debt, as the denominator in debt-to-GDP ratios expands more sluggishly. This exacerbates the burden of existing debt and limits the capacity for future borrowing. Finally, we are experiencing tighter financial conditions as central banks withdraw liquidity and raise rates to combat inflation. This combination of higher interest rate volatility, slower growth, and tighter financial conditions means that the assumptions underpinning decades of financial planning and investment strategy are being severely tested. Debt behaves differently when its cost is unpredictable, its repayment capacity is constrained, and the overall financial environment is less accommodating. This necessitates a fundamental reevaluation of risk and return for all market participants. History offers valuable insights into periods of high debt and financial transitions. While every era is unique, patterns emerge that can inform our understanding of the present. Debt-heavy periods have often coincided with significant economic and social adjustments, rather than outright collapses. These are typically times of restructuring, reevaluation, and recalibration of economic priorities. The post-Napoleonic Wars era, the interwar period, or even the Latin American debt crisis of the 1980s, all illustrate how economies grapple with excessive leverage. Debt rarely disappears. Instead, it is often restructured through various mechanisms: inflation, default, austerity, or sustained periods of economic growth. Understanding these historical precedents helps to remove the emotional charge from current financial conversations. It allows for a more analytical approach to potential outcomes, whether it's the prospect of sovereign debt restructuring, corporate deleveraging, or household balance sheet adjustments. For investors, studying these historical transitions can provide a framework for identifying resilient assets and strategies. For policymakers, it offers a menu of potential responses, albeit with their own sets of trade-offs. While the intricacies of global debt levels might seem distant from daily life, their implications permeate every aspect of our economic existence. Understanding how debt functions in this new environment provides crucial context for the pervasive sense of uncertainty many feel. It explains why economic forecasts are more volatile, why market reactions to news events are sharper, and why long-term financial planning feels increasingly challenging. For investors, this knowledge is paramount for constructing resilient portfolios, identifying undervalued assets, and navigating potential market dislocations. For students, it offers a critical lens through which to analyze contemporary economic challenges and policy debates. For policymakers, it underscores the constraints and trade-offs inherent in managing modern economies. And for the general public, it demystifies the forces shaping their financial well-being, empowering more informed decisions. Context restores perspective, transforming anxiety into analytical understanding. This episode has laid the groundwork by dissecting the evolving nature of debt itself. We've explored its historical context, its transformation in an era of falling rates, and its current role as a systemic imperative. We've seen how debt's character has changed for households, corporations, and governments, leading to a new era of financial sensitivity. In our next episode, we will delve into credit, the dynamic mechanism that allows debt to expand or contract. We will examine how credit creation and destruction impact economic cycles, asset prices, and financial stability. Following that, we will explore liquidity, the often invisible force that determines the stability of financial systems, revealing how its presence or absence can trigger stress or foster resilience. Together, these interconnected concepts provide a comprehensive framework for understanding the complexities of modern finance and navigating its future. If this analytical exploration of debt's transformation resonated with you, and if you found value in this calm, educational approach to complex economic topics, please consider liking this video. Your engagement helps us reach more individuals seeking clarity in today's financial world. To continue this journey through the intricate landscape of modern finance, and to gain deeper insights into credit and liquidity, I encourage you to subscribe to our channel. New episodes are released weekly, offering a structured and thought-provoking analysis of the forces shaping our economy. Thank you for investing your time in understanding these critical concepts. May your financial insights grow and your planning be ever more informed. And as always, I wish you a blessed day.